When it comes to taxes in retirement, oftentimes what retirees find is that the rules seem to change overnight. When they go from earned income at work to retirement income, taxes can be quite different. I think one of the things that we want to make sure of as retirees plan to transition from earned income at work to retirement is that you're paying the least amount of tax as feasibly possible in retirement. So today we're going to cover the 6 retirement traps that retirees can find themselves caught in and how to make sure that you are A, aware of them, and B, avoid them if at all possible. If we've not yet met, my name is Danny Sinowitz. I'm a CFP professional from Hyperion Financial. The first trap that we often see happens with people's pre-tax retirement accounts. Oftentimes, what people do realize is that this money was deferred. So they didn't pay tax on it while they were working, whether it be contributed to a 401k, 403b, 457 plan, or rolled into a traditional IRA. Since these dollars were never taxed, they're going to be taxed on the way out. The problem is when you stack this income on top of other income, such as Social Security income or pension income, you're going to pay this at the rate in which you take this out and the rate in which your marginal brackets will fall. So at the federal level, if we use a hypothetical example, and let's say that an individual has a $3,000 pension figure per month, he's married to his spouse, and that spouse and he have a combined Social Security income, $5,700 a month. So from an income standpoint, their guaranteed income is about $8,700 per month, which can make for a nice base of covering guaranteed expenses. If they have a significant amount of pre-tax savings and they only have pre-tax savings, such as, again, a 401k, 403b, or a traditional IRA, those dollars that would be distributed are then taxed at the marginal rates. The more income that they receive in that year, the more tax that they pay at the marginal rates. The more dollars that you take out in any given year from a pre-tax account, the higher the brackets can go. The problem is not being aware of the big jumps in income that you could end up receiving. In this case, you'd be going from the 12 to the 22% bracket. So any dollars taken out beyond the 12% bracket are taxed at a 10% higher rate from 12 to 22%. In the event that higher income earners could see jumps, you could go from the 24 to the 32% bracket. If that's the case, again, additional dollars would be taxed at 8% higher than they would have been on the previous rate. Since this is ordinary income, it would be added to the ordinary income brackets. And that brings us to our second trap that retirees can sometimes fall into, which is the RMD dilemma. The RMD trap that they can fall into is not understanding that this is an increasing amount each year, and understanding, again, that if you do not take the required minimum distribution, you'd be subject to a penalty. The penalty would be up to 25% if not taken of the amount that you should have taken. Now, if you do plan to take RMDs as you should, what would end up then happening is, again, those dollars are still added to your marginal income brackets. The problem that I think retirees fall into is not understanding that this percentage does go up every single year. So depending on which age you are and when you were born, if you were born before 1960 and you haven't yet started your RMD, it's age 73 in which you would have your RMD scheduled. If you were born after 1960, your RMD would start in the year in which you turn 75. Now, generally, this starting number is under 4%, whether you be starting at age 73 or age 75. But in years in which your account value goes up and every year in which you get older, that percentage could go up, and thus the annual RMD could also go up. By age 85, that's over 6.5%. By the age of 90, you're close to 9%. But understand that if all you have is pre-tax assets, that RMD will continue to rise based on your life expectancy. You're going to see a table here which will show you the actual life expectancy calculator. The way in which you calculate that RMD is you take the December 31st value and you divide the account balance by the multiplier, and that'll give you next year's RMD. The higher your RMD, the higher your ordinary income. The higher your ordinary income, typically the higher tax that you pay. That brings us to the third trap, which is actually the Medicare IRMAA premium surcharge trap. This is one that we did a prior video on, but just from a high level, the more income that you're bringing in from a modified adjusted gross income standpoint, if you cross certain thresholds, you will end up paying more in your Medicare premiums 2 years later. This can be a problem for retirees who, again, do not necessarily need this income, but are relying on Medicare. So understanding that as you bring in more income from a modified adjusted gross income standpoint, you could be seeing your Medicare premiums continue to creep up as well. Now, these Medicare premiums generally are going to be taking out of your Social Security each and every single year. So the net amount that you're bringing in from a Social Security standpoint will likely go down if those IRMAA surcharges go up. And speaking of Social Security, there's also the Social Security tax trap. The thresholds have not changed since the 1980s and the 1990s. If your provisional income is over $25,000 or $34,000 as a single individual, or if it's over $32,000 or $44,000 as a married filing jointly couple, some of your Social Security could be included in your ordinary income. The higher you go, the more that would be included before it reaches a cap of 85%. So if you're in a position where you have, again, those large pre-tax balances, perhaps a pension to accompany it, you may find yourself consistently in the 85% threshold where your Social Security dollars will be added back into your ordinary income. Once again, that goes to the ordinary income brackets, and the higher ordinary income that you have, the more that you pay in tax. This would also fall into the modified adjusted gross income as well. And this could again push your Medicare premium surcharges even higher. So, making sure that you have a plan to understand how much of your Social Security benefit will be taxable will have an effect on more than just one of the ways in which you could pay taxes in retirement. The fifth trap, I think, is one of the more devastating traps that retirees fall into, specifically for married individuals. It's often known as the widow's penalty, or what I would call the widow's trap. This is one that I think is one of the more sneaky ones that can end up hitting a retiree, especially one who recently lost a spouse. Going from the married filing jointly to the single brackets can be quite a jump, and not in a good way. As we just talked about on the previous examples, you have the Medicare premium surcharges. You also have your ordinary income brackets. You would have capital gains tax brackets. There's even what's known as the net investment income tax. In any one of those scenarios, it is less favorable to be a single filer than a married filing jointly filer. And while you may be thinking to yourself, well, if I no longer have a spouse, I won't be making as much income, that may be partially true in the sense that one of the Social Security benefits will go away. Typically, the lower amount would go away. But things that could potentially continue are the pension, assuming that the surviving spouse either is the one that had the pension originally or chose 100% or even a 50% joint and survivor life option. But the RMD would likely continue as well for the individual if their spouse passed away. This widow's penalty could present an example where you're making less income but paying more in tax. It's something that retirees should be able to plan for to make sure that the surviving spouse is not left in a position where they cannot afford the monthly payments that they would be facing because of taxes and a drop in income. The sixth trap that we often see retirees fall into is the inheritance tax trap. And this is one where it may not concern retirees because they're no longer here. It may also not concern you if you're not planning to leave dollars to children or heirs. But in the case where you are planning to leave dollars to children, one of the issues that comes up is the inherited IRA rules that they would be facing. Generally speaking, you have 10 years to liquidate a pre-tax account. So if you pass away with $1 million in a 401k or traditional IRA and leave that to one child, that one child needs to take out that $1 million in the next 10 years. Now, you may be thinking, well, that child just inherited $1 million. What are they complaining about? And that may be partially true. But the problem is that $1 million must be taken out over a 10-year time period. And depending on the income and the situation that the child is in, if they're in a higher income bracket, an additional amount of pre-tax dollars that would be taken out could present tax challenges for them. Again, we just talked about some of the examples being the capital gains brackets, being the net investment income tax. Another challenge would be the ordinary income tax rates that they would be having to pay. So while it may be the case that, yes, they're able to receive an inheritance, and that is a good thing, depending on their situation, a good chunk of that money could be going to the IRS or to the state government. Now, it's not likely possible that you'll be able to pay zero tax over the course of your retirement. Planning proactively to alleviate what some of these traps could present could put you in a position where you're able to enjoy more of what you have and keep more of what you've earned, rather than having that go to either the state government or to the IRS. If you've not yet checked out the quiz in the description, you should do so, because it's a way that you can go through your situation to see which of these traps you could potentially be falling into. And you'll get a video outlining exactly what you can do to look to avoid some of these traps. but some other planning items that could be at your disposal as you reach retirement. There are a number of different tools that are out there and some things that I think you should be considering. One of them that may not be right for everybody, but can be considered by some folks are Roth conversions. To learn more about how Roth conversions work, make sure you check out this video right here. It'll give you a better idea of how to potentially avoid some of these traps and keep more of what you earn.